Hey, John, welcome to the show.
Well, thank you I'm happy to be here.
So before we get started, can you give everybody just a little bit about your background and how you eventually started Wealth Trust?
Sure. Uh, well, I started with Merrill Lynch back in 1988, so I've been around for a little while anyway. And uh, after joining Merrill Lynch, I kind of wanted to manage portfolios on a discretionary basis. So Oppenheimer brought me over, and I believe it was 1994. So I actually started in a program there called the Omega program. So I was one of the few advisors that was allowed to manage portfolios at that time on a discretionary basis for our clients. The cool thing about it, when I was at Merrill, and you probably know this, they would tell you got to build a position in a particular stock, right? And so the nice thing about being able to do it on a discretionary basis, is you could take care of your small clients as well as your larger clients. So that's when I actually started managing portfolios on a discretionary basis. From there, I went to Prudential, which actually became Wells Fargo Advisors. So I was one of two groups at Wells Fargo Advisors that was allowed to manage portfolios for the clients of other advisors at Wells Fargo. So, by the way, I was audited by Wells Fargo legal team a lot. I was kind of like the fish out of water, if you know what I'm saying. And so after a while, in I guess it was 2015, I said I need to form my own RIA. And at that point in time, I left Wells and started WealthTrust Asset Management. So at that point, we had to actually start our performance over again. And just to relate back to that, Wells Fargo would not allow me to take our statements with us because our long-term growth portfolio basically has outperformed the S&P 500 65% of the time since 2000, for the last 21 years. So that's how we got started with managing the Wealth Trust long-term growth portfolio.
It's wonderful. You and I have a similarity. We both started at Merrill. I probably didn't last as long as you, though. I think I was only there for about 9 months. But
I wish.
yeah. So I always like to ask, though, before we start talking about the business and the ETF that we're going to talk about today, is what do you like to do when you're not behind the desk? Any hobbies, interests?
Oh, that's a good one. Well, I am a golf widower. I don't know if you ever heard of one. There are very few of us. My wife is the golfer in the family. I met her on a blind date playing golf, and she actually, fell in love with golf. She wanted to play golf so she could meet a man, and so she met a man, but she fell in love with golf. So to this day, she's the golfer in the family. I'm a boater. I like being out on the water, doing a little fishing, watching the sunset go down, late in the afternoon. Down here, we live down here in Destin, Florida. So down here, everything is named after Indians. So we live on Indian Bayou. So we have a direct access to Akawachi Bay. And that bay is just beautiful. And so I like to go out there and just relax. That's my time to unwind, if you know what I'm saying.
Yeah. A lot of boaters on this show. It's funny, but there's something with managing money and the love of water. I'll maybe figure that out at one point. But before we talk about WLTG, which is your long-term growth ETF, let's talk about Wealth Trust as a whole. I know, like I said, you have the ETF, but are there any other services the firm provides? Is there any way you're working with clients outside the ETF?
Sure. We manage portfolios on 6 turnkey asset management platforms. So we actually manage portfolios for advisors. We have 12 strategies that we currently manage, from small cap, mid cap, fixed income, conservative fixed income, large cap, and long-term growth portfolio. And we have 2 balanced portfolios. So we do that. The 2 balanced portfolios are 5-star Morningstar portfolios, and the long-term growth portfolio is a 4-star portfolio. We just got GIPS approved in January of this year, which is, if you know, that's a very difficult thing to do. So now our firm is GIPS approved. I guess we can call themselves a 4 or 5-star portfolio managers. So we manage portfolios on other turnkey asset management platforms like Envestnet or SmartX, Orion Communities. So clients can have access to us through those programs used for other advisors. We really enjoy managing portfolios for other advisors. And one of the things that we do that's very different is that we actually do webinars with advisors and their clients. And we try to get it to where the advisor themselves participate into the webinars so they can actually, after a while, they understand our methodology and they like to talk about it. So we work with advisors and their clients to present our methodology. I like teaching. In fact, my daughter said to me, Dad, why don't you just become a teacher because you love teaching what you do? I said, well, I think I'll stick with what I'm doing.
So you bring up methodology. I think you have a really interesting methodology. I want to jump into it. I want to talk about it in depth. And it's the ticker is WLTG, which is the WealthTrust Long-Term Growth ETF. Before we get into the weeds and the details about the product, at a very high level, what is this ETF trying to accomplish?
Okay, well, it's a growth at reasonable price ETF. So it competes with the Russell 1000, although it has a more of a growth stint to it than the Russell 1000 or the S&P 500. I like to identify companies that have good quality earnings, good quality dividends, basically that I know I can depend on them. I worked for a company in St. Louis when I graduated from college. It was this S&P, it was a 500 company. And we would actually do things to manage expectations for the quarterly earnings. So we would have the chief financial officer. I was the director of financial reporting for the company. The chief financial officer would come into me all the time and say, hey, we want to beat the consensus estimate this quarter by 2 cents. Okay. Well, guess what? We would do things. They were generally accepted accounting principles. By the way, my wife says to me, honey, if you don't brag about yourself, I'm not going to brag about you. And so we, at Wells Fargo, at this company that I work for, we would actually do what's GIPS approved. We passed the CPA exam the first time, or I passed the CPA exam the first time I took it. And so therefore I know what GIPS allows and what they don't allow. And so we would do things. So my background basically was in industry itself, working for an S500 company. And so what we try to accomplish is to identify companies that have great quality earnings, great quality dividends. For example, if a company has a lot of deferred expenses, that's not quality, right? They got to come back onto the books eventually. If they have no deferred income, that's a good, or they have some good deferred income, that's a good thing. So the goal is to outperform on a reasonably priced basis. Our PE is very close to the S&P 500, but our growth rate is around 19%. So our PEG ratio, PE divided by the growth rate, is 1.1. So our goal, make it long or make it short, is to outperform on a reasonably priced basis.
Makes a ton of sense. And so if I understand this correctly, you guys, this particular fund is broken out into almost 2 distinct strategies, right? So first, let's talk about the analysis piece. So you're running a screen to find high probabilistic companies that are more likely to beat earning estimates. And then there's a kind of a secondary strategy, which we'll talk about later, which is momentum based, or you're combining them to get your outcome. So are you able to talk about some of the factors you're using to isolate a company that would have a high probability of beating their earnings estimates?
That's a good question. The database that we have has 9,000 companies, and I've been using it for 21 years. Now, back when I started using it, there was about 3,000 companies. So it's 9,000. It has about 1,700 American depository receipts in it. So it's kind of like the who's who of all the companies that you would consider buying. So I started screening that. I built my own screening criteria for the things that I think is important. My PEG ratio, my PE ratios. So when I do my initial screen, I could do that anytime. So, once, 2, 3 times a week, I'll run my screens, and I end up with about 400 companies out of those 9,000 companies that meet my screening criteria. And so we call that the art of portfolio management. It's taking those 400 companies and identifying what you like in those companies. For example, we talked about earnings quality, dividend quality, quantitative ranking. Quantitative ranking is probably one of the most important things as far as us identifying companies that's going to consistently beat their estimates. So let's just say that three research analysts, they go out and visit a company today and tomorrow. And let's say one of those research analysts is a 5-star analyst. And let's say the company actually beat their consensus estimate last quarter. So they come out, they visit the company, and they all raise their estimates in a significant way. Let's say, for example, there's 20 companies that follow, 20 research analysts that follow that company. So 3 of them raise their estimates, and that falls into a buy signal or strong buy signal for us. Let's say those 3 analysts, they go out and they do just the opposite. They lower their estimates for this quarter, and so in a significant way. So that throws us into a strong sell discipline. Now, there might be a time when, the 3 analysts disagree with each other. So one might, or 2 might increase and one might just be neutral or decrease. That could fall into just a normal buy category. So we have 5 levels of quant analysis: strong buy, hold, sell, and strong sell. Now, the problem with the market or any index itself is that it has a lot of companies that are in them that have estimates that are going down. In the S&P 500, at any particular point in time, the S&P 500, between 15 and 20% of the companies in the S&P 500 are what we call quant 4s and 5s. So those estimates are going down. So we don't buy those 4s or 5s in the first place. So let's say we buy a quant 2, a company that's estimates are going up, and all of a sudden it goes from a 2 to a 4. So in other words, estimates start going down. Well, that becomes our sell signal. So if we have a 4 or 5, you have up between a 70 and a 90% chance of that company missing its estimates. The market misses 25% of the time. Since we don't buy the 4s and 5s in the first place, and since if it does go to a 4 or 5, if it goes to a 5, we sell it immediately. If it goes to a 4, we will watch it until maybe the day before earnings come out. If it's still a 4 the day before, we will sell it 99% of the time. That results in us missing, or actually only having, let's look at it the other way. Our earnings beat 95% of the time, where the market only beats 75% of the time. So that's quantitative analysis. Like I said, we look at companies that we think have good growth potential to them, have somewhat of a dividend, and the quantitative analysis helps us have lower standard deviation. Our downside risk factor is, I was just looking at our long-term growth portfolio, our downside risk factor is 0.85 on the downside, down capture, which is pretty good. So we're more concerned about having a lower down capture and having it close to equal on the up capture. Standard deviation is below. Great alpha, great beta.
So John, when you're running your screen, looking at the portfolio gets fairly concentrated. So you're going through all of these. You go through the screen, then you go through your quantitative factoring, you're finding your buys, you're finding your sells. How many names are you targeting to get into this portfolio at any particular rebalance?
We're looking at potentially 25 to 30 names. Okay, we really like to get it up to about 30. And by the way, since they are large cap or mega cap companies, like I said, I work for a Fortune 500 company. They have a better opportunity of beating their estimates. Now, they might only be an average on a quant ranking, like a quant 3, but large cap and mega caps can do things that small companies or mid cap companies can't. So we're looking at 25 to 30 large cap or mega cap companies, and then they also have a strong possibility of beating their estimates.
So how often, you said you're kind of rerunning the screen, maybe 1 to 3 times a week. Are you rebalancing this portfolio quite frequently, or do you have it on, a weekly, monthly schedule?
No, it depends what the market's doing. For example, in 2022, our trend analysis program told us to go from growth to add some value into it. And so we were actually taking some trades off of, we had some of the Magnificent Sevens in our portfolio that did very well in 2001. But in 2022, we actually took some money off of that and started buying some value. So in 2022, it was smart to do some trades. Prior to that, there might be 3-4 year time period where we have the same stocks in it for a very long period of time. When growth is in vogue, we want to have as many long-term growth portfolios that we can. We want to keep our capital gains down to the lowest minimum that we possibly can. But at the right time, you got to switch. You can't just stay with one particular sector or asset class.
So that being said, you're holding on to names for quite some time. When kind of initially building the portfolio, are you equally weighting these 25 to 30 names? Are you providing some overweight to your strong buys? Are you letting things run? Like, do you ever pull things back into maybe a more strategic line?
That's a good question. It's actually something that we're in the process of doing now. We've had some great runs on NVIDIA. It's kind of like maybe now might be a time to, we're up to like 4.5%, I believe, in the ETF with NVIDIA. This might be a time to bring it back down to a 3% level. So that is possibly going to happen currently. If you think about it, since 1988, there's always been an asset class or sector that performed well, except for 1 year, and that was 2008. And even in 2008, if you had treasuries in your portfolio, you made money. So, for example, from 2000 to 2002, if you remember that, the market was down 45%, right? That was because the technology bubble. QQQ was down, 70% from 2000 to 2002. People don't even talk about that anymore. So, but if you would have started buying home builders in 2002 or housing related stocks in 2002, you actually made money during that year because you're in the right asset class, the right sectors. So that's what we do. So basically it's tactical in nature, sort of quant rankings, and our methodology of identifying these 9,000 companies will give us, research analysts know what their sector's doing. They know what the stocks or the companies in their sectors are doing better than anybody. They get paid their bonus money based on how close their estimates come to actual results. So, they do a good job of estimate earnings revisions because that's how they get paid. So if home builders are performing well, they will show up as quant ones and quant twos. If commodities are performing better, they will show up as quant ones or quant twos because the research analysts are telling us that their earnings estimates are going up.
So this is a pretty loaded question, John, but I figured if anybody would have a insight into this, it'd probably be you. Historically, companies that are consistently beating earnings, what level of outperformance are they kind of exhibiting over a benchmark or over, let's say, the S&P or Russell? Like, if you're consistently quarter in, quarter out beating estimates, I know this is going to be a wide range. I guess I'll simplify the question. If you have consistent earnings beats within a particular company, are you expecting them, or do they historically always kind of beat the benchmark?
Yeah, that's a good question. If you look at the quant rankings, just to give you an example, quant ones and quant twos average around 25% per year since 1988. Okay, so if you can identify a company that, let's say it's a quant two, you're outperforming you're getting about 20% return since 1988. Guess what? The quant fours and quant fives have averaged about 2% or 3% per year. Estimates are going down. They missed their estimates. So I would say, I've never done that analogy before, but I would say that it's significant to have long-term growth companies that pay somewhat of a dividend, that can consistently beat their estimates. And by doing so, I say you outperform. I can't quantify it, but I know based on my history that that's how we make a lot of money.
Yeah. So when you get down into your screen, you again selected 25, 30 names. Do you have any sector or industry guardrails to prevent kind of maybe over concentration, or do you just let the screen drive allocation?
Yeah, that's a good question too. And it goes back to the quantitative analysis. Okay, it goes back to overweighting sectors that are the right sectors to be. For example, in 2005, the Fed started raising interest rates, right? Why were they raising interest rates? Because commodity prices went up so much. Well, we bought an offshore drilling company, a Chinese offshore drilling company at $3 a share. It went to $130 a share. So there's times to be in the right sector, the right asset class at the right time. And there's times where, we look at we can actually look into the S&P 500 and see the actual allocation. Okay. Last year, which is amazing, Google for a while, it was in the S&P 500 two times, and it was 10% of the S&P 500. So, did we have 10% in Google? No, there's no way we would do that. Did we have 4% in Google? Yes. So I don't know if that answers your question or not. I think it.
Well, I think a follow up to that would be you run the screen. Let's just say 80% of the companies are in one particular sector. Do you just let that be, or do you say, hey, look, we're not going to let more than 40% of the portfolio be in technology?
I will typically never go more than what's the technology. For example, in technology, right now it's 40% of the S&P 500. I will never go above that. Okay, I want to make sure that I'm at least, but I want to have the best companies in technology.
Right.
That's the difference. I mean, you could have technology, you can buy a technology index, but then you have a lot of companies in technology that aren't performing. So do you really want to own Intel or do you want to own NVIDIA, right?
So part two of your process is an AI momentum overlay. So what is it about that momentum factor that can help provide kind of additional confidence or even outperformance over just running the screen itself?
Yes, that's probably the most exciting thing I've been doing in the last 3 years. So our portfolio basically has two groupings. 25% is in passive ETFs. Okay, 75% is in these large cap and mega cap stocks. So let's talk about the 75% first. So starting last year, 12 months ago, I identified the ability to find out which companies in the Russell 1000 are in QQQ, are in VTV, the Vanguard values, which companies have the most momentum. Now, what I do is I can pull those and I take them and I put them into our screening process using our quant ranking, our quant analysis, our normal quantitative fundamental analysis. When do you sell a company that's up 30% this year? Or do you buy a company that's up 30% this year? Okay. A lot of money managers, they look at it's up 30%. I'm not going to touch it. It's already up 30%. Well, it could be up 60% by the end of the year. So when do you sell it? Well, you sell it before earnings estimates go down. Well, when earnings estimates start going down, you sell it when they have a possibility of missing their estimates. So that's the cool thing where we're able to identify the companies in these ETFs, basically, or it could be any ETF that have the most momentum. We take them and then we double screen them with our quant analysis. All right. And by the way, we go the other direction too. So for example, of those 400 companies, we might identify a company that's not a perfect match on momentum. Maybe it's just an average match. And we take that and we put it back into our watch list. Okay. Let's say we buy it. Like I think Tyson Foods is one of the stocks that's in our portfolio. We identified it as a average match, even though it's not a perfect match for momentum. And now it's gone from an average to a good match. So we'll track it both ways. So it's a double check on each other. So we check through the momentum. We have the momentum stocks. By the way, in the Russell 1000, we get a email basically that has the top momentum stocks. It'd be about 125 companies in the Russell 1000. Take those 125 companies, we put it into our quantitative analysis, our normal fundamental, our 21-year analysis. And we say, okay, we like this stock, and that stock. And it helps us identify companies that have good momentum, but also what we like in a company. Low PEG ratios, quality of earnings, quality of dividends. Does that make sense?
Yeah, makes a ton of sense. Go ahead. Sorry, please.
The other 25% we've been doing for about 3.5 years. So the other 25%, we use a trend analysis program. We have 14 ETFs that we identify as potential additions to that 25%. So right now we have 4 passive ETFs, QQQ, mostly growth ETFs that are in that portion of the portfolio. So let's say that the trend analysis says, okay, QQQ is trending down. SPYG, the S&P growth index is trending down. And guess what's trending up? It's the Russell 2000. It's small caps, or it's the mid caps, or it's value. Okay. So it allows us, that's what we did in 2022. We identified when it was time to get out of growth and put some more investments into value. So we sold a lot of these ETFs, that 25% in these passive ETFs, and bought value ETFs at that particular point in time. So the Russell 1000 growth, I think, was down 38% in 2022. And we were down significantly less than that because of our move from growth to value. Right? Now,
So
the best thing about it, I'm sorry.
no,
the, best,
please go.
the best thing about it, if there's no momentum in any of those 14 ETFs, guess what we can do? We can buy a treasury, a BIL, a short-term treasury. If we think we're going to recession, we can buy a TLT, a 20-year treasury. We can buy gold, and we have the ability to buy an inverse ETF if we think it's necessary. We haven't done that yet, but if we really think that we're going into a recession, we can buy an inverse ETF for that 25%. And by the way, I did a study on inverse ETFs. They're really good for a short period of time where it's one-on-one. But if they're held for a year or longer, they only protect for about 37.5%. They're not a one-for-one. If the market's down 50, they'll be up 37.5%. So I've done that analysis, and I know that it's still better than not having that inverse ETF, correct? But it's not a one-for-one if you hold it for 12 months or longer.
Yeah. So you kind of answered my question, but I'll ask it directly. So from a portfolio manager's perspective, you have a ton of confidence in 75% of your names, and this 25% using kind of broad-based ETFs is your way to add either in an up market, diversification, or when a market cycle starts to change, it gives you the ability to manage risk.
You said it. I mean, I couldn't say it any better.
So is momentum the only driving factor for the ETF selections? Are you running any quantitative, screens on kind of these large indexes, or is it just purely a momentum play?
On the indexes, it's purely a momentum play.
And
on
then,
on the individual stocks, we do the screening down to 400, and then we go back and we watch momentum on that. But individual stocks, it's more quantitative. On the ETFs, it's more trend analysis, if that makes sense.
Yeah, it makes a ton of sense. And just to follow up on that, so on the stock side of the portfolio, can waning momentum ever be an indication for you to cut exposure or sell? Is it a change in rank that's going to be your sell signal?
That's a very good question. And right now, QQQ, when I did an analysis on QQQ, and I wanted to identify the top 10% that have the most momentum in QQQ, there was about 30 stocks in QQQ that had that high momentum. Today, it's down to 10. Okay. So, and so what's happening, which is really funny, the Russell 1000, the top 10%, was about 100 stocks. Now it's up to 185. So we're starting to see this broad-based, return, where it's going from mostly QQQ technology, Magnificent Seven, and we're starting to see at this particular point where it's actually broadening out to the rest of the Russell 1000, to the rest of the market, the large cap market.
So if you're sitting down with an advisor kind of today, where are you putting this in an already diversified model portfolio? Where is WLTG sitting?
Well, it's probably should be part of an SMA, for a large account. For a small account, for a family member that only has $10,000, is probably a good thing to use for that. So it could be core for smaller accounts, and I think it should be part of an SMA for larger accounts. But I like what it does, so I'm kind of prejudiced on how much it should be used.
So the ETF is fairly new. Kind of two-part question. What drove you to start it and get it out there, since you have a successful SMA business? You're working with a ton of, really great TAMPs. So what kind of drove the decision to launch? And then how are you kind of thinking about growing this ETF over the next handful of years as you kind of get your 3 and 5 year numbers?
That's a good question too. I started at the wrong time. I started in December of 2021. So I think that's what a lot of people do. They kind of make that mistake and they think, oh, the market's doing great. It'd be nice if I had an ETF to provide for the advisors that I work with. I work for, hundreds of advisors, with hundreds of advisors. So I thought I'd have that for their smaller accounts. and so they could actually use our long-term growth for larger accounts. So that's why I started it. And so what we're trying to do, we're on a couple different programs. Where we're actually Wealth Advisor Magazine. I don't know if you've heard of them. The Wealth Advisor Magazine is promoting us on their website. We're doing it through LinkedIn. We have a company called Be Seen, so we're doing it on LinkedIn. We're identifying so we can send information out to RIAs. And we're at the point now, we got it up to close to $29 million in assets. Okay, so that's kind of like we're trying to get to that $30 million point. And so the next thing to do is get our spreads narrowed more. I think when we do that, it'll be more attractive to advisors and clients. So there's ways that we can do that, and it's something that I can't really talk about now, but there's ways that we can narrow that spread. But I want to say this to those individuals that were thinking about buying it. We have 11 market makers, okay? And so if somebody wants to buy a large block, they can go to their block trader, whether it's Schwab or Fidelity, and they can say, go to the market makers. I want to buy 10,000 shares of WLTG. So they can go to the market makers and they will get a great execution if they do that, as opposed, you don't put a 10,000 shares of market order on our ETF. You have to go, maybe 100 shares, you can do that. But 10,000 share, 25,000 share purchase, you want to go to the market makers and make sure that you're getting a great execution somewhere between the bid and the ask.
Yeah. Well, I mean, John, I think, the investment advisors that are listening to this and model portfolio providers, that this product, I think, is a great complement to just traditional large cap growth exposure. I don't think it's just a small account solution. There's a lot of people that are running ETF only model portfolios, are delivering to TAMPs, and I think this would be a great complement to help drive some alpha in that large cap growth bucket as they're building portfolios.